Why am I not? I need to record this. Especially because this is the last session. Okay, so what I wanted to cover, Sis Miss, is a business structure. So just holistically, not just talking about tax. So I wanted to cover the business structures so that when you guys go here and then you can decide which vehicle you want to invest in as you start um, with your investment journey than having to do the bank reports, which we all know you can find on myroof.co.za. There's nothing new I'm going to teach you about there, but I think you'll benefit a lot more if I go into details about the business structures. So I'm going to put up a presentation. If everybody is in agreement with me, let me see. There you go. Can you see my PowerPoint here? I'm trying to do, there we go. Can you see my presentation here?
Yes.
Okay, perfect. So, so what I wanted to cover is what is the right property investment vehicle for you. So, you know that in South Africa, there's different ways that you can buy property. You can even buy them through REITs, or you can buy shares, you know, in a property company. But the reason why we also have this as another way of buying properties is because when you buy properties, obviously using the bonds, and you are able to actually leverage, get a home loan for it, versus if you were to buy property shares, it has to come out of your pocket. So you have to have enough savings to be able to buy those shares. Or if you want to buy a property ETF, you know, you have to have enough saving. But that does not mean that you can't invest. I don't know how many of you know about easy equities. You can even buy easy properties there. And so you literally, you have an investment in an actual property company. So almost like you own the properties, and then every quarter they pay you dividends based on the rental income that they're getting. I don't know also how many people know about the REITs, is that the REITs is the same way as well, is that you actually invest in a business that's going to invest in properties, and all the income that they get from the rental income, they actually distribute, you know, as a and they don't get taxed. Excuse me. So you get taxed, that the money actually only gets taxed in your own hands, because the REITs are saying, so the fund managers are actually managing those properties on behalf of the investors. So, and then all the income that they get from the company, they actually do distribute.
How do you call it, Ms. Doris? RE80.
Let me type it in the chat.
Okay, thank you.
And then you can Google it. REIT. I think it stands for real estate investment trusts. So in other words, they distribute all the dividends. You know, like if you are a trust, you distribute all the dividends, and then the trust does not have to get taxed. So the way they are set up is that the REITs, and they are listed on the JSE, is that if you buy a share in an REIT, is that their role is as compared to companies. So if you're buying a share in a company, remember, they might not pay dividends that year. Some year they may pay dividends, some years, but they are, when a company is an REIT is that by law they are supposed to distribute all the income. Then so obviously they have rental income minus operating expenses, paying the fund managers fees, and but all the income that comes from the business, from the rental income, gets distributed to the investors every single year. So you can look at that as one of the options. And then also an easy properties is on let me just put it in here. Easy properties, you also get to own the properties. They pay dividends every quarter based on their rental income. So you know, if you are one of those people that don't want to, you know, you want to diversify your portfolios, to say you still want to invest in property. So let me just type it there. Easy properties every quarter, and they are, so you find them on, they are, sorry, so they are on Easy Equities platform. those are other ways that you can definitely invest. Let me just find the right wording for REITs. REIT. Yeah, I'm right. It stands for Real Estate Investment Trust. So if you want to Google it, so but otherwise, even you just put in REIT, Real Estate. So there's a number of companies that are registered. They need to register as such as an REIT company so that they don't pay tax. So, and then you get taxed when you receive that rental income. So, but basically it just means that, you know, you're investing in the property, but somebody else manages that property for you. And then on a quarterly basis, and then you can get paid dividends. What smart people do, they look at the different REITs. Obviously, they look at the returns, how the fund managers are managing, and then you can say, I'll buy one REIT with this company. If it pays, let's say, dividends every quarter, you say if it pays March, June, September, and December, and then you invest in another one that pays dividends in February, so that on a monthly basis, you're always getting dividends. So you can always track it that way using different, or even if it's just maybe every 2 months, you know, maybe somebody that pays in January or something like that. So you can always do that way. But it's one way of making sure you can invest in property without you having to manage those property investment. Obviously, the downside, like we're saying with this, it means you have to pay. That money has to come out of your pocket. Versus when you buy property yourself, is that you can go to a bank and be able to get a bond. So this one is going to have to be whatever savings that you are making, and then it's equivalent to buying properties cash. So let's put it that way. So when you invest in these REITs, it's equivalent to buying properties cash. You can also buy, remember, you can also buy properties ETFs, property ETFs, your exchange traded funds, your properties ETFs. Like, for example, you can find this on your Cetrix. It's got a property ETF. The nice thing about the ETFs is that you can actually buy them under your tax-free investment. You know that every year you are allowed to invest 36,000 tax-free, meaning any other income you're getting from that investment will not be taxed for life. So if you wanted to look at a tax-free investment but still invest in property, you can invest in you can go through your Cetrix. Obviously that there's more than one, or the actual platform, which is ETF SA, and look for different property ETFs and just look at their returns. You can still invest there, but the benefit of an ETF, you'll find it also under a tax-free investment. Anyway, so that's just sharing a little bit of the knowledge. But now let's talk about you going to buy properties yourself. So what is the right property investment vehicle of the ones that you're going to go and get a bond and stuff? So why isn't my enter not working? Okay, let's try that again. Okay, so why do we need to consider the investment structure? Obviously, your number one is your taxes. You know what they say? They say there are 3 things that are showing in life: death, taxes, and change. Okay, and we're going to cover 2 of those. So we're going to cover death and taxes. The reason why you have to consider structure, especially before you buy, you know, I always say that, you know, the people that come here and they haven't bought any properties is the best place to start when you don't have property. But once you already have, that means you have to think a lot more about structuring that might already have tax consequences. Okay, it will have tax consequences. If not, having to incur additional costs such as your transfer fees, or having to register a new bond because now you're moving it into this other structure. So when you don't have properties, this is a good place to start to consider the structure. So you need to consider your tax consequence. And then the second one that you need to consider is 2 things: is your financial efficiency and also asset protection. Is to say, okay, so once I made this money, is my structure going to make sure that my assets are protected? Whichever mechanisms, you know, I'm using today, is it going to make sure that my assets are protected? And then the last one is estate planning. So estate planning is just literally meaning that long-term tax. So here we're talking about short-term tax. Here is the tax that you pay when you die. We call it the death penalty. So you gotta think about what happens for you when you die. We're thinking about an estate when somebody passes on. You say, what is going to happen to your assets when you die? What are the tax implications? Anything, any implications? What are the financial implications of your estate when you die? If you don't think about the estate plannings while you're still alive, there'll be serious uh, financial consequences. Okay, so I said in South Africa, there's typically 3 investment vehicles. Okay, you can either buy in your own name, which is your individual, or you can buy in a company which is now a PTY Ltd. We know that the closed corporations are no longer allowed. And then the third one is that you can buy through a trust. So here I'm talking about the inter vivos trust. This is the trust that you set up whilst you're still alive. There's a testamentary trust that gets set up on death. So somebody can say, because my kids are small, when I pass on, I want a trust to be set up. That's what it is a trust that is based on a will. It's based on the testament. You know, the will is called the testament. So if you put it in your will and say, when I pass on, I don't want the uncles and the aunts and whoever's honestly looking after my child or the legal guardians to be able to sell the assets that I've built. I want the assets to move into a trust. That one, we call it a testamentary trust. So there's a trust that is set up after the death, you know, of the owner or the donor. Okay, but this is the trust that you can set up while you're still alive and say how you want the assets to be managed. Okay, so an individual, why do I keep on seeing this window? Oh, sorry, I need to go back. I can't see my heading, I need this window to go. Okay. Yeah, so the pros, so there's advantages and disadvantages of each structure. So I'm gonna start with the individual. So when you buy property in your own name, okay, so this thing keeps on coming here. So when you buy property in your own name, you're likely to obtain 100% bond with good credit record. Remember, and with individuals, affordability, good credit record is very, very important. So the banks also look favorably at an individual than companies or trusts, because they like to have a person that they can say this guy owes us. Okay, because they know how easy it is for companies to close down. You can literally close down a company and go start another one next door. Okay, pays the cheapest form of tax. As an individual, we'll look at the different taxes. The disadvantages is that you are exposed to creditors in your own name, exposure to estate duty on death, and assets will be frozen. You're required to register as a provisional taxpayer. So in this case, if you're making any taxable income from your rent for more than 30,000, you are required to register as a provisional taxpayer. So besides you being registered in SARS and getting a salary, you need to make sure that you also register as a taxpayer, which is twice a year you file, and then the third time you do a top-up payment if you did not pay enough taxes using the provisional tax system. Okay, so another one that I have not mentioned here is not a nice one to hear, but the cons is also that when people do divorce, and when they own properties in their own names, depending on how you're married. Okay, so the implications are significant in terms of how you get to split the assets. So when people do divorce, is that if you own as an individual, obviously if you're married in community of property, it means everything has to go 50-50. So assets and liabilities have to be shared 50-50. So if you haven't thought about that, and then you get thrown in the end, most people end up having to sell those assets so that they can have money to settle the debts. Because also even remember that if you've got a property that you co-own, so let's say for example it's a husband and wife and then they owned a property, and then when they divorce, in an event of a divorce, and then they decided to split 50-50. So it's either that means that other spouse needs to sell their 50% portion, but the downside is that other spouse needs to be able now to afford the bond on their own. If they don't afford the bond on their own, that means now they have to sell. Okay, so the implications, are significant there if you are an individual, but there's a positive. So the positive is the tax. As an individual, depending on your bracket, okay, you will pay cheapest form of tax in terms of the people in the lower brackets can pay 18%, which is cheaper. Obviously, the higher form of brackets from 1.5 million and up, which is not that a lot of people, they end up paying 45%. Okay, and you pay tax in two ways: rental income or capital flips. Okay, so when you get rental income as an individual, it will get added onto your salary minus all the expenses related to that property, and then you are able to get the net income. Will get taxed at your effective tax rate. So whatever you're paying, the effective tax rate is, if it does not move a bracket. Okay. Same thing if you're gonna be doing capital flips are taxed 100%. Okay, so there's not a capital gains tax. If you buy a property, you renovate, and then you sell, it gets taxed 100%. So very important. So this would get taxed same way as your rental income would get taxed. So at the end of the year, you need to make sure that you've taken tax into account at your effective tax rate. Okay, so that's the income tax part. So the second part, I can't see my mouse for some reason. Just can't see my mouse. Kind of like this little screen here. It distracts me. Okay, so you also have capital gains tax. This is for property that you hold for a longer period of time. On capital gains tax, profit on sale, so the one that you hold and you rent, and eventually when you want to sell, is profit on sale of property. You get a capital gain. If you're an individual, the first 40,000 of that gain will be exempt, so it will never be taxed. You get 40,000 as an individual per annum. Doesn't matter how many properties you sell, whether if you sell 5 properties and then you make 1 million, you'll only deduct 40,000. If you sell 1 property, you make 100,000, you only deduct 40,000. So it's not per property, it's just per annum. An individual is allowed to deduct 40. So if you own a property with your spouse, which means between the two of you, you'll at least have 80,000 in total for you to deduct from those gains that you're getting from that property. And then once you deduct the 40,000 that is not taxable, then you are left with whatever amount. So only 40% of the gain is taxable. So that's the beauty of owning property as an individual, is that when you have to do capital gains tax, is that it's the cheapest because only 40% of your profits or your gains will be taxable, okay, when you are an individual. Okay, so asset protection, there's no asset protection. So whether you've got an gas account or you've got a credit card account, if you ever get sued, somebody takes you to court and say, hey, so-and-so owes me money. If you've got properties that are paid up, they can literally take those properties and sell it to recover their money. So the sheriff can attach anything that you own to recover the money. So there is no asset protection when you own properties in your own name. So anybody, any creditor that you own can literally with judgment and be able to attach any of your properties. Okay, so you are exposed when you own properties in your own name. Estate planning is that when you pass on as a homeowner, there's estate duty payable on death. Obviously, this is what we call a long-term death. So typically there are 3 taxes. So let me just tell you what happens. Okay, not 3. So SARS will take you 3 times. Okay, so that's what we call it. Estate duty is like death penalty. You pay tax because you died. So that's what we mean. I mean, it's a sad story, but SARS you can never get away from SARS. So you pay tax. So SARS will take 3 ways. So if somebody passes on, let's say somebody passed on 31st of January 2021, so which is none of you because you're already in February. So somebody passes on the 31st of January 2021. What SARS is gonna say is that on your 31st of January, I want your tax from your salary. So that's the day you must pay all your taxes from all your income. So you're gonna say, okay, we're gonna assess you. Last assessment for tax purposes, executor must pay all your taxes from your salaries. Your income tax is due. on the date of death, 31st. So you can't be waiting for assessment in September. So you need to be assessed on the 31st of January. That's the first one, on your normal income tax. You are now have to be assessed 31st of January and pay all your income taxes. Second tax is that SARS deems that all your assets are sold on the date of death, which is that 31st of January 2021. So because the assets are sold, which means capital gains tax is due. It is payable. So this is now your second taxes. You will see here, we'll say, remember on the previous slide, I said 40,000 is exempt. Now on this one, let me just see a small picture. Yeah. So on this one, only 300,000. I mean, it goes up to 300,000 on death. So if your capital gains are above 300,000, then you're gonna have to pay tax. Okay. And the tax is payable on the market value of the properties on the date of death. Okay. So whatever properties that you own on the date of death, the market value is determined minus your purchase price, and then you have to pay taxes on those. Okay. Then the third tax that we're talking about is this one called estate duty.
Sorry, sister.
Yeah.
300,000 is exempt from what? If you've got a property, and which is 300,000 means you're exempt. Is that what you mean?
No, your profits on the properties, your gains.
Okay, on the profits. Okay.
Yeah, only on the profit. No, I get it. You only get tax on the profits, on the gains. So SARS is gonna say to you, so let's say, Sis Macy, you bought a property, let's say 10 years back.
Yeah.
And then you bought it for 700,000. So by the time you pass on, if that property has grown in value, so let's say now the market value on the date of your passing is 2 million rand. You bought it for 700, then when you pass on is 2 million. So I was gonna say 2 million rand is the market value minus the 700,000, which means now the growth, the capital gain on that property is 1.3 million. So the gain on the property, or the capital gain on the property, is 1.3. Then SARS is going to say, because you passed on, you do qualify for 300,000 exemption. So it's going to say the 1.3 million gain minus the 300,000. So only 1 million will get taxed of that gain.
So 40,000 for someone who is alive, but when you're dead, 300.
Yes, 100%. 100%. So when you are still alive, you get to deduct 40,000 from all your capital gains, and then on death you get, so the exemption goes up, that the tax exemption goes up to 300,000. Unfortunately, you don't get to see it yourself because you'll be gone, but your beneficiaries will get some money back, technically, by that increased gain of 300,000. Yes, so, and then the last tax that is payable is estate duty. So how estate duty it works, that estate duty is payable on your net asset value. Capital gains looks at market value. So you just take them, it says, let's look at your market value minus all your cost of those assets. How much did you buy them for? And then it works out what the capital gains is. You get your exemption, and then taxes payable. So your executor has to pay that tax, okay, based on your effective interest rate. Like if you're an individual, then after they've calculated your capital gains tax, and then they have to come to estate duty. So estate duty says all your assets. Okay, so all your assets, meaning your house, your cars, if you're owning any paintings, so anything that you own in your own name that is assets, minus any death expenses, okay, any liabilities you have. Okay, so this is different. So capital gains tax looks at the purchase price. Okay, so it will say you bought this property for 700,000, the gain is 1.3 minus the 300, and then we tax you. You still have to pay that tax. Or at 40%, obviously, only 40% of that is taxed. And then estate duty says, so that's different to capital gains, it's your third tax. Estate duty says, we take the market value of all your assets, okay? And then we minus the outstanding debt. If it so happens you only had that one property, Sis Macy, it means they would say 2 million minus the outstanding bond. If it so happens that you paid off your bond, né? So that would mean now that the full 2 million rand has to get included into the estate duty. So estate duty looks at whether you still have debt on that property. So if you do not have debt, you are happy to say, hey, my assets, my properties are paid up, or your car is paid up, or whatever you are doing. If there is no debt, that means your net asset value. So if we assume it was your only property, it means your net asset value would have been that 2 million rand. So think about typically, like if you were to do like a commercial property, for example, is that the value could be so high. Okay, it could be 5 million, it could be 10 million. So if you've been paying that over the years, that the outstanding debt or the outstanding bond is so low, it means the value of your estate is actually grown by a lot. But you also have some reprieve. So if your net asset value, which means your assets minus your liabilities, is above 3.5, you would only pay estate duty if that net asset value after the minus your liabilities is above 3.5 million and the estate duty is 20%. Okay. So in addition, remember that you still have to pay the executor, you have to pay the master's fees. So the executor's fees are payable up to 3.5. So 3.5 is the cap, but you can't pay it lower. I personally work with Capital Legacy. They do charge less, and you can also take insurance over those fees if you decided to make them the executor. Okay, so what do you do? So typically also assets that you leave to your spouse, by the way, would get minused from this NAV. So you won't pay estate duty. It will just get transferred to them when they pass on. Okay, but other than that, all your assets, all your net asset value above the 3.5 million will attract estate duty at 20%. Then what do? I always say, listen, everything is, so there are people that already own properties in their own name currently. Make sure you take enough life cover to cover your fees plus your liabilities. Okay, and be able to leave some money for your beneficiaries. So in other words, so when you're doing your life cover, you need to sit with your financial planner and say, how many debts do I have? What is my current outstanding bonds? What is my current credit cards balances? Maybe you've got a car that you finance. What is, so make sure that your life cover minimum, it has to cover all your debts. Why? So that when you pass on, your family must not be left with the debts. Okay, so in addition, you need to make sure that it covers the fees, the taxes that you're going to have to pay as an individual. This is your capital gains tax. This is your estate duty, if it's any payable. If you do not have enough money in your life cover, please note that the executor would have to sell your existing assets to cover those taxes. Okay, so taxes take a priority. Okay, and same thing is that the executor take his fees, and the one that I have not said here, the executor takes his fees, by the way, based on the market value of the assets. He does not take into account the liabilities. It does not matter whether you've got your liabilities exceeds their assets. He does not say market value less liabilities. The fees are payable based on only the market value of the assets. Okay. So it could be quite a significant amount there that you have to pay. So if there's not enough money in your estate, then the executor will have to sell your assets so that there's money for those taxes, the income tax, capital gains, his fees, the master's fee. Master fee is not much. I think it's about 7,000 or so, and then the estate duty. In addition, if you are going to be an SBI, guys, have a will. Don't let your family try to decide for you on your behalf what you must do. Okay, if you are merging in community of property, you can only say what you want to see happen to the 50% of your share. Okay, so you can't talk about the full 100%. So in your will, you say all the assets that you've got that you've accumulated with your spouse, obviously your share will be 50% of assets and liabilities. But in this case, then you can say in your will how you want your assets done. As a parent, remember, you don't have to include your kids as beneficiaries, but any child that is still dependent on you, you cannot exclude them from the maintenance. You don't have to leave kids assets, but a parent death does not alleviate you from your responsibility to look after any dependent child. Remember, they have to prove that they're dependent on you. So it doesn't mean that just because you're a parent, you must give each child equally share, right? You can decide, I want to leave that child with a car. Maybe that one is more responsible. I want to give them that apartment, that one. But if a child is still a minor, even if not a minor, but if a child still stays with you, you're supporting them by law, you're supposed to provide for them in your will for maintenance. Okay, so you can say, for example, even if we put everything in the trust, you can say to the trustees, still give child number one 10,000 rent, maybe child number two only 5,000 rent. You have to still provide for them if they were dependent on you. But otherwise, if they are adult kids, you know, you said, you know, you want to give your money to charity, you can do that. You can give 90% of your wealth to charity. You can give it to your parents. You can give your brother, your sister. The only thing that the law would fight against you, what we call it, preclude you from doing, is if somebody was dependent on you. Even if somebody was not your official child, like your mom or your brother, can prove that they were dependent on you. You used to support them, and now that you've passed on and you haven't left them anything in a will, they can contest your will, but they have to prove that they were dependent. So the onus is on them to prove it. But otherwise, you can make sure that everything you put in a will. So everybody make sure that you do have a will. Most of the entities that we know, even attorneys, they will draft a will for you for free. Okay, so any questions before I move to the next structure? Does it make sense? Any questions?
No, Doris, I'm fine.
Okay. Okay, let me do the next one. I'm assuming Mrs. is okay as well. Let me do the next one. So company. So the next one is if you buy property in a company, what are the pros and cons? The nice thing about companies, you know what the tax rate is. So there's no ambiguity to say, hey, if I increase my income, my tax bracket is gonna increase as well. I might end up having to pay 45% and. The nice thing about, we all know what we're gonna pay upfront, 28%. Even when you run the numbers, you can say, hey, let me put aside 28% tax. But as an individual, you can't do that, because the more you earn, the more you move a tax bracket. The second advantage of a company is that you can deduct most of their expenses, especially if you've clearly, okay, was I cleared? Especially if you've clearly separated it from individual expenses, okay? Make sure that you always have a separate business bank account for your business. So don't mix business with personal. Even if you have to borrow the company money, rather take company money from your check account, and when you transfer it into your company, and just say director's loan or shareholders loan, whichever is the case. Okay. The disadvantage is mostly when you're doing funding, the bank will require 20% deposit. I'm saying most cases, because they do fund 100% depending on the value of the property. Because remember what I said to you when we were running the numbers, that banks works on a loan to value basis when they're doing the funding for the companies. So if, for example, the property you want to buy, the value is R1,000,000, if you sign an OTP for R1,000,000, then the bank will say put in 20% deposit, because you are buying through a company. So there have to be equity that is put into the business, also for the bank to cover themselves. But if the property, for example, is R1,000,000, but you buy it for 700,000 because you're an SPI, you buy it below market value, it's still within the bank's LTV of 80% loan to value, LTV of 80%, the bank can actually give you 100% bond, because you are buying it at below their maximum requirements of 80%. So the bank can still give you that full 100% bond, because now you are buying it for 700,000. They know the market value is R1,000,000. So you're actually buying it at 70% LTV. If you've got that affordability, there's no reason why they can't give you 100% bond. Okay. So, but the bare minimum is that they would require a deposit if you're buying in a company. 2-year financials are a prerequisite unless it's a new company. And then you can say it is new, and then you have to provide your own affordability because there's no income in the company. Then your accountant will have to give them a letter to say that the company is still dormant. But the moment it starts trading, whether it's one company, just know that you are required to keep proper financials. Make sure that you've got up-to-date financials, you've got management accounts, not more than 3 years, because now to buy your second property, you gotta show management accounts for that company. So as you grow, you just know that keeping proper accounting records is a requirement for you to be able to borrow in a company, and your accountant has to be involved all the time. For example, when you buy property, your accountant has to sign in conjunction with you. There's letters that, I mean, I'm doing another deal at the moment. I just sent my accountant, let me just show you here. Yeah, it's called certificate of transfer. So there's lots of the stuff that he needs to sign for. Just to say the company is solvent, it can afford to do this and that. So your accountant always has to sign. So it's just the added admin when you have a company. But once you've got the relationship, with your company, I mean, with your accountant, then you know what is required upfront. But the most important one is that you gotta keep your financials up to date. Okay, so management accounts, not more than 3 months. Directors are required to sign surety for the company. The beautiful thing about surety is that it actually does not affect your individual affordability, because even though you sign surety, it's still not your debt. It's the debt of the company. It only becomes your debt when the company defaults. That's what I'm saying. When you're buying in a company, at least your affordability does not get maximized as compared to when you buy in your own name. The bank will say, hey, you've reached your affordability levels of 30% of your income. Okay, then in terms of expenses, yeah, there was supposed to be something here. I think I thought you can deduct most of the expense, and I had a list of expenses here. I think they've disappeared, but you can deduct most of the expenses. Maybe just to cover is that, for example, if you've got a car that is paid up, you can actually even sell it to the company, so that the company can be able to claim depreciation. You can now put petrol as an expense in the company and claim it for tax. Your maintenance can now be paid for by the company. This is something that would have come out of your pocket anyway, right? The difference here is that you get to deduct it for tax if it's in the company. Okay, so the way to look at it from company versus individual is that for an individual, you earn an income, you earn a salary, and SARS says pay me tax, then whatever is left, you can go and pay and do expenses. But from a company point of view, so this is the magic, the aha moment of using a company as an individual. The SARS says, company go make an income, then deduct all your expenses. I mean, guys, there's few things that probably the SARS would not allow as a deduction in a company, but majority of the expenses that you incur in a company are tax deductible. Okay, so you can literally say income minus all expenses, from car expenses, fuel, and this entertainment. If you go meet with clients somewhere, you can do entertainment, and which you will not be able to do it in your own name. So if you don't have a PTY LTD, majority of the expenses that you incur, even just going to be able to view properties, using your own petrol, is going to be tough to be able to say, SARS, when I was actually buying this property, I drove for so much, and I think I used petrol, so give me as a direct expense toward my investment property. It's not going to be easy. I mean, SARS, you can motivate for stuff, but I'm just saying it's not going to be easy. But if you have a company car, if the car is owned by the company, you can put the petrol expense under the company, maintenance under the company, So there's lots of expenses that you can deduct under a company, your depreciations, your wear and tear allowance, depending on whether it's a new building or not. So the Section 13 deductions for tax purposes, that when people do developments, that they get to benefit from. Okay, low cost housing, it's got tax benefit as well. So, so there's a number of stuff that you can deduct when you buy properties in a company. You can actually do this course for example, do a mentorship and let the company pay for it, get a deduction for it. So instead of you having to pay yourself a salary and say, okay, let me get myself a salary, and then from that salary, let me pay for the mentorship, because you can put this under your company and say it's training, skills development, you know. You can literally put expense under the company. In other words, you get to spend first before you pay tax. That's what a company does for you. You spend first and then you pay tax. But if you do it as an individual, you would pay tax first, and then whatever is left, then you're going to spend. Magic. So income tax, just quick, tax at 28%. Capital gains, only 80% of the gains will be taxed, compared to 40% as an individuals. That's why I said from the individual point of view, tax is the most benefit. Okay, so 40% from the individual point of view of any gains that you make on your properties, but as a company, 80% of the gains will be taxed. So all that means is that if you've got a property that you bought, so let's say you bought the property for 500,000 and then you sell it for $1 million, that means the difference, which is 500,000. So you're going to have to say 500 times 80%, and then the 400 will get included in the company's taxable income. Okay, so 80%. There is no exemption. Remember, as an individual, you got an exemption of 40,000 when you are still alive, and on death, you get a 300,000 exemption. The company does not die, so there's no talking about estate duty, but there is no exemption. So you only pay tax flat at 28%, or other as an income tax or as capital gains tax, only 80% will get included in that income tax bracket and get taxed at 28%. Asset protection, a company is a separate legal entity. Can be liquidated, but owners can start again. So if something went bad in business, you can liquidate it and let the company get blacklisted for not being able to pay whatever, and then you can move on. That's why people are able to start another business again, because a company is a separate legal entity. Obviously, your exposure is through surety, that you said to the banks that I'm going to take this debt. Should something go wrong, I can take over the money. You can come after me to recover your money. So that's the exposure of directors. But because of the company, guys, you can actually take insurance. You can take insurance over the director's sureties. You can say, I want to take insurance. You know, some insurance could just be only 3 months. You know, you can take for credit, you know, to cover the credit. Even so, should one of the directors pass on and they've signed surety, you can take the life cover to cover that. All the directors, as I said, should they pass on, but the company pays their insurance, they get to have that as a deduction. And then you say, should them think, okay, except for life cover, the SASSA does not allow it as a deduction. But you should say, should something happen to that one of the directors, and then we can actually claim from the life cover and then settle the debt. So that way the company becomes debt free, but the property is still there making money. Estate planning, a company it's got a perpetual life, does not die, so you don't have to worry about estate duty from the company's perspective. So it will continue to, so just because a director has passed on or a shareholder, it does not mean assets must be frozen. No, it does not work that way. So there will still be, the company will still be able to operate. All it means that the shareholders, it was a sole director, it just means then you have to hire another director. But there's a big but. If you own the shares in the company in your own individual name, so in other words, the Sis Mercy owns 100% shares in the company, then everything else that is applicable under an individual will be applicable to you. So capital gains tax will be applicable, estate duty applicable, but based on the value of the shares. So the value of the shares, so you'll have to do, the executor, they'll have to do, get somebody to do evaluation of the company and find out how much the company is now worth, whatever value. If you own 100%, then 100% of the value of those shares will get included in your estate. If you only own 50%, then only 50% of the value of those shares will get included. Let's take an example, for example. So let's say you started this company from scratch. And when you started, you said, I'm gonna only issue shares of 100 rands. Okay, I'm gonna say 100 shares issued for 100 rands each. So that's the only thing you've ever paid. Remember the bond that is in the company, that's the bond of the company. It's not your own bond, it's not your own debt. Okay. Then what happens 20 years down the line, you pass on, and then what SARS says is gonna say, oh, how much did you pay for the shares in the company? Only 100 rands. Okay, so what is this business worth now? The business is now worth 15 million. So SARS is gonna say 15 million minus 100 rand. Okay, 15 million minus that cost of your shares. That's the capital gains. You have to pay capital gains tax on it, and then you have to pay estate duty if that value is above 3.5 million. If you don't have any money in your bank account in your own estate, that means the executor can sell your shares to make money to pay for all those things. So same thing, master's fees and the executor's fees are applicable up to 3.5% of the market value. I feel like I'm talking too much. Any questions before I go to the last one? Are we all happy? Was it too much information?
I think we're fine, Sis Doris, but we would like this to be shared to us.
Okay, that's fine. I shall share it.
Even the last one we requested, I never received it.
Which one is that?
But you know, we're supposed to be getting all this material. We've not been having it lately. Because
Yeah,
the board should share, she doesn't.
Yeah, which one did I share? Maybe I'll email it to you directly as this message. Which one was that? That I owe you from the last time, that if Lebu didn't send it to you.
Yeah, the last one, and then the second to the last one also.
Yeah, but last one, what were we talking about last one?
This last one, I think we were talking about no, I think repossessed property, and which one again was repossessed, and there was a name that we used.
Back to back.
Yeah, it was back to back, was repossessed, and yeah.
But we didn't have a presentation then. What was I supposed to send you there? I didn't have a
Was there no presentation?
No, there was no presentation. The last one, I didn't have a presentation. I only showed you on, remember we use private property.
Oh yeah, that's true.
I showed you properties you can go and view on private property. We did, we went to Lightstone and just see how much the people bought for the ones with the terrible ones. There was one in Kempton Park that looked terrible. Unless you're talking about 2 modules before, I would have to check what the topic was then. But this one, I'll email it to you directly, Sis Messi, because Lebo is not here anymore.
Thank you.
So it's kind of so that I don't owe you, especially because this is my presentation. So I'll email it to you directly.
Okay, thank you.
Okay, so the last one is the trust. So the trust, let's talk about the advantages of the trust. The trust is good for estate planning and asset protection. So the way the trust works is that a donor would put assets in the trust and then employ the trustees to look after those assets through the trust deed, telling them what the assets are for, and then the trustees have got the responsibility to look after those assets for the benefit of the beneficiaries. Okay, so the way I like to look at it is, so in terms of the trust, nobody actually owns the assets. I mean, think about it. So even though the trust is a legal person, it's not actually the same way as the company, you know. So if you think about it, right now, if I tell you my company name, you can really go to CIPC, look up for the directors, and if the company has done something to you, you can sue it. A trust cannot be sued, by the way. If you did not know, a trust cannot be sued. But the trustees can be sued on their individual capacity for if they mismanage the assets of the trust. Okay, so because the donor or the founder would have put the assets in the trust for the trustees to manage them for the benefit of the beneficiaries. So the beneficiaries can actually sue the trustees if they felt that the trustees mismanaged those assets. Okay, obviously they have to understand what the trustee said and stuff. And obviously the donor can also be the trustee and can also be the beneficiary. You can actually set up the trust. You can become the trustee yourself and also become the beneficiaries. Okay, obviously for the rule for the trust to be valid is that you have to have an independent trustee, and the independent trustee has to be part of every single decision. If the decision is not taken without the independent trustee, that means those decisions are taken in your own individual capacity. That means you haven't relinquished control. Okay, so the trust means you've got no control. You are relinquishing control of the assets into the hands of the trustees, including the independent trustee, for the benefit. So that independent trustee is there to make sure that whatever is said in the trust deed to say this is how the assets must be managed, this is how the assets must be distributed, is actually done. Okay, it's always better to make sure that your independent trustee is somebody that is legally sound, knows how the trust is supposed to be managed and administered. I know people like to say, oh, I'll put in so and so as a friend and whatever. When you're doing an independent trustee, it either has to be a lawyer, it's got to be an accountant that understands and keeps up to date to the laws and the regulations of them, how a trust needs to trust administration. I mean, I haven't. The last time I did do what was at school, and we don't really get. I don't think we get that many exams regarding the trust. So somebody that has to do that does the trust administration day in and day out, they're making it their specialty. Are a better person to become your independent trustee. So you don't want somebody that the last time they saw anything that has to do with the Trust Administration Act was 20 years ago. So that's why your independent trustee needs to be qualified in terms of how you administer the trust, what is required by the law and stuff like that. Assets are not frozen on death, whether the trustee or the donor or the beneficiary passes on. It's got nothing to do with the trust. Life goes on. What that trustee will do or that beneficiary will do, will just put it in their will to say, listen, my share that I normally get from the trust, I want it to go to so and so, and that's it. So nothing gets frozen. Trust assets are protected from individual creditors. So typically it means if you are a donor or you're a trustee or you're a beneficiary, if you ever get into trouble, no beneficiary can come, no creditor can come after the trust assets. The only people that can come after the trust assets is the bank. So if you've got a home loan, obviously, and you haven't paid your bond, the bank can still take that property and sell it. Okay. The cons, the trust is taxed at the highest tax rate. Unfortunately, the same way that the company has got a flat rate of 28%, the trust tax, its flat rate, it's got a flat rate 45%. So in other words, if you were to make profit in the trust rental income and you've got successful business, so let's say you're making 100,000 profit per month, it means of that 100,000, 45,000 you must give it to SARS every month. Because what happens when you put in the assets in the trust, setup costs are also high at the moment, plus or minus 8.5. If you're doing it through the bank, I know FNB currently, because one of my students went there, and I always ask them to do comparables. 12,000 if you want FNB to set up the trust for you, and if you want them to be the independent trustee, they charge an extra 3,000. So it's 15,000 per annum. You can work out what the monthly cost will be for that. Annual trust admin fees are also applicable. They can either be, you can pay them annually or monthly. So some administrators will require that you actually pay it on a monthly basis than having to wait for a lump sum. I mean, I know I've got more than one trust. I tell you guys, I pay them annually. I pay the fees annually, and they always kick in in November. You know, that time when you planning to when you're planning to pay school fees and then in December, yeah, and then it just comes by surprise. You get a notice end of October to say, note, your annual trust admin fees are due and it will go off on this date. Yeah. So it's not a nice thing. So sometimes when you do set up these structures, guys, it depends where you are financially. And that's why not everybody can start with the ideal structure. I'll talk about the ideal structure now. What time do we have? Okay, so I'll talk about the ideal structure at the end, but every structure is dependent on where you are at. Okay, so where you are starting at, but always build slowly so that when you're now able to get enough income from that first property, then you are able to put up, because you don't want to put in 10 properties in your own name and then the next thing you are too exposed. Okay. So the tax on the trust, same thing as an individual technically. So you get tax, income tax, 45%, while individuals 18 to 45%. But tax can be avoided in the trust by using what we call the conduit principle. So the conduit principle says that when the trust ends the income, it can actually distribute that income to the beneficiaries. So that way the trust avoids paying the tax, because then that when the trust distribute the income, it will get tax in the hands of their beneficiaries. In this case, remember that it also that does not lose its form. So in other words, if that income was rent, it will still be rent in the hands of the beneficiaries. If the income that was distributed was dividends, it will still be dividends in the hands of the beneficiaries. The dividends is exempt. If the income was interest, it will still be interest in the hands of the beneficiaries. Interest, for example, the first 23,600 is tax exempt, which is nice. So if you can distribute some form of interest, at least the individual gets to benefit. Then capital gains tax works the same way as the company. So 80% of the gains will get tax, will get included into the income tax and get tax at 45%. No surprise. 45% flat tax rate. Asset protection, I've already said, is a separate legal entities. The trustees are exposed through surety. An independent trustee is required. You gotta have a separate bank account. Estate planning, perpetual life, a trust does not die unless you say in your trust deed, this trust must be around for 25 years, and then after that, it must be dismantled. I can't remember the right word that they're using for the trust. There's no estate duty applicable, so same way as the company, because it's got perpetual life, so it does not die. So when you pass on, none of the assets that are in the trust would get included into your estate. Okay, whether you are a trustee, whether you are a beneficiary, but it's very important that you make sure that the way you set up your trust deed is that you don't make any of the capital or the income to vest in the hands of the beneficiary, because if it vests, then it will get included in their estate. Typically, how we set up the trust deeds, we'll say the trustees, this is a discretionary trust, so that both the capital and the income will get distributed to the beneficiaries at the discretion of the trustee. So that way, that income or that growth in terms of the assets will not vest. So in other words, so let's say this may say you are the only beneficiary in your trust. So it's just you as the trustee and an independent trustee. So what happens, and then it will say when you pass on, if it's not a vesting trust, we call it if it's a discretionary trust, or nothing will actually get included into your estate. That's how we set up the interviewer's trust. We make it discretionary at the discretion of the trustees. The other reason why we also do it that way, for example, if we want to distribute money, for example, to ourselves, the trust has done well, we managed to get rental income from the trust, we can choose, instead of distributing it to myself and my husband, we can distribute it to the kids, because the kids will have less tax because they don't have any other income. If that is their only income, we know that at least the first 83,100 of their income will be tax-free, okay? Because they don't have any other income. And then after that, then they get taxed at 18%. So you can choose whoever pays the least tax to distribute to them. Okay, even though you know the money's going to come into the family. So that's why we make this type of trust to be discussed. So if you're going to be buying income generating assets into the trust, then you have to use the conduit principle to avoid paying tax. Okay, so in other words, every time you make a profit, you must distribute it to the beneficiaries. You can choose which benefit. You don't have to distribute to all the beneficiaries. So you can choose which beneficiaries to distribute to. Okay. Typical example, I just wanted to show you how the tax will work on the three different structures: individual, company, or trust. So here, let's assume Lerato buys an investment property for 500 all costs and then sells it for 700, which means there's a capital gain of 200,000. If she buys it, if she owns that property as an individual, it means the gain would have been 200. So the gain is the same for everybody. So because it's 700 minus 200, so 700 minus 500. So as an individual, you made a gain of 200,000, but because you are an individual, you get that exemption of 40,000, which means your taxable gain is now 160. But because this is a capital gain, you are an individual, only 40% of that will get included into your taxable income. So SARS will say 160. My mouse always disappears. SARS will say the 160, which is this one, times 40%, it becomes 64,000. Then 64,000 will get added into your tax, whatever your salary was for the year, total salary was. I just assumed here that maybe you were already earning the 1.5, so I've assumed the maximum tax of 45%, and then in this case, where's my mouse? Okay, your tax at the highest rate would have been 28,800. Same place, if you own this property as a company, 200,000 would have been your gain, but the inclusion rate is 80%, not 40 as compared here. You include 80% of that profit, which will be 160,000. So 160,000 will get taxed because it's a company at 28%, which means your tax for the same property would have been 44,800, assuming there's no other expenses deductible in the company. Same way, trust 200,000, inclusion rate 80%. You get a taxable gain of 160 times 45%, and then your tax would have been 72,000. Okay, you can see the different levels from the same amount, the difference that is owned by different persons. So this own individual, company, and then a trust. So the maximum would have paid as an individual 28, company 44, 7. You can see the companies are somewhere in the middle there. Okay, so, and then I said, what is the ideal structure then? So given all that is into account, so there's two things that you can do. Okay, so the first one is, so I'm saying this is the ideal. So ideal structure is that you set up a property trust. Okay, so it depends. You have to think about when you're doing property as a business, you gotta think also about what we call financial efficiency. I talked about asset protection. You gotta think about a financial efficiency. Financial efficiency says, if you're an individual, okay, the NCA will be applicable. The National Credit Act is applicable to individuals. The bank cannot lend you more than 30% of your gross salary towards your home loans. Okay, so there is a ceiling. So financial efficiency, it says to you, because you're an individual, when you want to buy properties, which means for you to be able to keep on being able to get that property, you have to increase your income. Plus, remember, the 30% is the maximum. Plus, they still have to take into account your other expenses to determine affordability. So most people, you do hit a ceiling if you are an individual. So if you buy property in your own name as an individual, the problem with that is that with financial efficiency, you are going to hit a ceiling fast. Okay. So even though the tax will be the nice one, second thing is because now your issue is asset protection plus the estate duty payable on death. So you are exposed as an individual, but your taxes will be lower if you're earning, around where you're paying tax around 18% plus, you're going to get 40% only as included as capital gains. Okay, So the other school of thought is that you can buy as a company, obviously, because you know your tax is going to be 28%, but because of the exposure, in terms of the value of the shares, like I said before, even when you pass on the value of the shares. So what is the ideal? The trust gives you that asset protection, so nobody can touch the assets, and there will be no tax consequences when you're done. There's no estate duty. You can put the trust here, but because the trust pays the highest form of tax, okay, we don't want to buy income producing assets into the trust. Remember, you can have a family trust where you can put up any assets, maybe your own house where you're living in, because it's not generating an income. Once it's paid up, you can decide to protect it by putting it into a family trust, because it's not income generating, so you don't have to worry about paying the taxes. But we're saying the stuff that is income generating, right? Rather do a property trust like this, and then put in a holdings company here. This is the structure. Let the trust own 100% shares here, and then let the holdings company own 100% shares in your operating companies. So let's say Property Pty Ltd, where you're doing your buy-to-lets, multi-lets, or your flips and whatever. You can have different companies as you like. And then have your development company. Must never mix development with normal residential property. So have a development company separate. So the holding structure here, why do we have a holding structure here? It protects you from having to consult with the, remember here I told you, if you've got a trust, there has to be an independent trustee. If you've got direct shareholding here, which is nothing wrong with that, it's just that every time you need to make a decision that requires a shareholders to sign off, it means you always have to consult with the independent trustee. So this is kind of like a smart way to say, you know, you still want to have control even though you don't have ownership through the holdings company. So you become the director here. So anything that requires shareholders approval, you can approve it here because the holdings company is the shareholder. So you can approve it here as the director of that holdings company. You get to approve anything that requires shareholders approval here in the operating companies. I know it's a kind of like too much information, but if you're saying to yourself, what is the reason why you're buying your assets? No, I want to be able to live off this income. Every single year, I want to be able to distribute my income. Then that's fine. You can buy the assets directly into the trust. So your motive for buying the assets, you can buy, but just remember that means every single year, you can never grow the income of the trust, okay, without having to pay tax. So what you have to do is that you can buy properties directly to the trust if you want it, but just know that you're gonna have to. It's not a good financial efficiency model, because the trust will never be able to borrow on its own, because it does not have income. It does not retain any income, because the reason, remember, why our companies are able to, so a PTY Ltd, you know, is able to borrow on its own, to have its own affordability, is because we're going to leave some net income in the company. So next time when we go to the bank, we're going to say, hey, look, our company is profitable. We have a profit. This is now after paying our taxes. We still have, you know, 72,000 left. So you can show to the bank that without your own affordability, or you having a pay slip, the company from its own rental income is able to borrow more. So that's why we're saying, if you want to do it as a business, a PTY Ltd is a best structure for you, because eventually after the 2 years, if the company is profitable, the company can be able to finance itself to be able to buy the properties without requiring affordability from the directors. Okay, obviously the directors will still have to sign surety, but you don't have to show your affordability if the company is. You can do the same thing with the trust, by the way. You can show affordability in the trust. The problem is, for you to be able to leave any income in the trust has to pay 45% tax on it. It will be ridiculous for you to pay 45% tax when you've got another vehicle that you can pay 28% tax and still be able to borrow or raise a home loan on it. Okay, that is my story. And on to the business structures. Any questions? Any questions? Are we all happy?
Can you throw more light again on this one, Sis Doris?
Pardon?
You talk of a property trust, that's the trust that you have, but at the same time, there's a property holding company.
Yes.
Yeah. But yeah, can you just throw more light?
Okay, so I'm saying, so the property trust would own 100% shares in the holdings company. So the holdings company does not trade. Okay.
Mm.
So you just have a trust there. So the trust will own shares in the holdings company. Then the holdings company will own shares in your operating company where you're going to be buying these properties. So this is where you want to do your buy-to-lets and your multi-lets, whatever strategy you're going to be following. And then this holdings company can come back here when you get into your development strategies, and then you can also own shares in your development. This is also your operating company. Okay, but this holding does not trade, and the reason for that is that so that there is what we call it, you are limiting control or involvement of the independent trustee. Because if you own shares directly like this, so every time anything requires shareholders approval or even shareholders surety, you're going to have to go to the trust. I mean, the one thing that my attorney said to me said, you must never let the trust sign surety for anything. You don't want the creditors to ever lay hold of your trusts. So you want to put the holding structure. So from the operating point of view, if anything requires shareholders to sign surety, you do it in the holdings company instead of going to the property trust and say to the banks, the trust owns this. So in your case, you only show to the banks that the shareholder is that. And then also when you have to sign consent for things as a shareholder, you use the holding company. So that way you have control, because in the holding company, you'll be the only director or whoever is your partner or whatever. But in the trust, you do have an independent person that you always have to consult to make decisions. So you want to limit that. Okay, so you want to make sure that you don't have to involve this independent trustee when you have to do deals in the operating company if the trust is a direct shareholder in the operating companies.
Okay, so for this to work properly, you have to actually register this property holding company, the property company, the trust, and the development company.
Yeah, well, development, you don't have to do it now, just when you get into development. But for now, you can have the three entities. You can have the trust, and you can have the holdings company, and you can have the PTY Ltd.
Okay.
Yeah. So I do, for those that don't have the trust, I do assist with the registering of the trusts. And obviously we all know how to register a company. If you don't as well, I do provide that service in my consulting company. So if any of you ever needs this assistance, I do have a consulting service where I do the services.
Okay.
Yeah. Sis Maud, are you happy?
Yeah. Information overload. Information overload, but it's very interesting.
Okay.
Yeah.
No, Askis, I know that this type of things, always overwhelm people, which is why we here as accountants to make it easier for you. You just need to set up this structure once, okay? So you
Yeah.
just do it once at the beginning, you don't have to worry about. So that we normally have an administrator here that administers the trust. So even me personally, I don't get involved in any of my trusts. So the administrator just sends me forms every year and says, is the trust still dormant? I said, yeah. And then he goes and he files. That's it. So you don't have to get involved in terms of, oh, am I filing? So all you have to focus on is your operating company. The
Yeah.
thing is, you do need to set up the structure at the beginning, okay? And then when your accountant files for, where's my mouse? Always, okay. When your accountant files for the operating company, he files for tax, even for the holdings company as a dormant company, doesn't charge you for it. So you'll only pay audit fees for here, for the operating company. This is just a protection structure. So we always file 0, so it's always 0 tax here. So 0 tax in there. Okay, so which means from the property trust point of view, what you've got in your balance sheet, it will just be shareholders equity 100. There you bought the shares for $100, so it's just shares in holdings company, and then donations from the donor. You would have donated that $100 US, and that's it. So that's the only thing that remains in that trust forever and ever. So that's whatever you for tax purposes, we register everything in cost. That's it's different from accounting purposes. So these guys here, literally from administration point of view, your accountant's job in the trust is literally just to file every single year with the tax. Make sure that you are tax compliant. So because our for example, our trusts don't trade, so there's no operating, literally our fees are low. And I'll tell you now, ABSA, we did ours donkey years ago, so it was still with ABSA. The fee has not changed drastically divided by 12. I'll tell you what we pay on a monthly, about 580 for the administration of the trust. The administrator just files for us because we need an independent administrator or accountant to do that, to verify whatever we're saying happened in the trust. Yeah, and then that's it. So same thing here. Here your accountant, you make them the same accountant. He files a 0 tax return here, happy days. And then here, that's where you pay the actual taxes and where you're trading, where the income comes in. You don't have to worry about it and stress about the structures, but you do need to put it up front once, and then that's it. Okay.
Okay.
All right, guys, I shall send this through. I think Sis Macy, I do have your email because you've sent me something to you. Maud, I'm not sure if I do have your email address. Please let me know, and then I can just email to you guys directly without having to own. Maud, can I please have your email address?
Can I put it in the chat?
Yeah, sure, that's fine.
Okay.
That's fine. You can do that. Guys, any other comments? This is our last official, what do we call it? Session. It does not mean that you're not gonna see me. Definitely tomorrow you'll also see me on the Q&A session. But this is just the last official engagement that we have. I don't know what I'm Riches and Beyond is planning regarding the graduations and the stuff. I'm sure they'll be in touch. So yeah, so you guys were our first group, guys. So hence I'm saying I'm not really sure how you're our first online guys. Put that way, you were first guys. So there was a lot of learnings that we had to do. So do bear with us. We do apologize where things are still not working. So you were the guinea pigs of the online thing because of COVID. So we had to test the waters with somebody. But guys, the beauty of it is that you would have access to the recordings anytime. So if you want to refresh anything, so that's what I like about online, is that now we've got content that somebody can go. It's like having a book. You know, you can go back and be able to listen. You can be able to go and watch, and something that you want to focus on, that you want to refresh on, because this was done, especially having to do this every 2 weeks. You know, I know it's overwhelming for other people, but you can say, okay, now I want to focus on, so let's say I want to focus on capital flips, to just go and watch that module and then take the notes and so you've got that benefit, you know, to say you will still have access to that module. And if you want to go back and do notes about back to back, you go back to that module, you know, and yeah, and review.
Do we still have access, Sis Doris?
Pardon?
Do we still have access?
You should have access. I mean, as far as I know, you should have access to your modules for life, unless anything else changes. So as far as I know, you should have access to your modules for life. Yeah. So you are a student. You are a student of R&B for life. So whatever you paid for, you should still have access to it.
Yeah.
Yeah.
Okay, dogs. I see it's only us left now, the ladies.
Yes, I know. I think Chris was struggling with connection shame. He
Yeah,
kept on coming in and coming out. Unfortunately for him, but he should hopefully. I'll actually chat to him. I'll post on the group that for those that missed today, they can always do my next session if they want.
yeah.
If they really
I
want to join.
actually I met up with Chris sometime this week. There's a property that we've identified. He's got a few, but there's one that I'm interested in
Yeah,
for Doris. So I want to just run the numbers and then I'll send that to you. It's in a
that's fine.
very
That's fine.
the area is very scary. It's a very scary area.
Yeah.
But I think there's potential for multi-lets in that area.
Okay.
And the
Okay.
person who's selling the property is selling it at a giveaway, really, I think.
Okay.
Very low price. Yeah. So I just want to run the numbers.
Okay.
And then that's why I said I want to watch that module again,
Okay.
run the
That's
numbers for that property, and then I'll send it to you.
okay. No, that's fine. Just definitely. So to do your risk assessment as well to find out why the property is selling at low, because there could be a risk there. Make sure that you will be covered and how
I
you're
think
gonna be.
it's the area. It's the area that it's your. It's scary. It's not a
So
place that I would want to live personally, but I think
yeah,
there's a lot of
but
potential for people to rent in that area.
yeah, but would you be able to collect rent? That's the issue. So
Yeah,
make
that's
sure
the
that
other thing. Yeah.
yeah, you think about how to mitigate. So find out if there's a letting agent that does management there for multi-lets,
Mm,
because you need to think about that. And if there's one and they are successfully at it, how do they
mm,
deal with non-payments? How do they chase people
mm.
and stuff like that? So do your due
Yeah,
diligence, not just only with the numbers, but in terms of the risk assessment, because
yeah, yeah.
being an SPI means we do a risk assessment as well and say we can invest in this type of properties because we know we have mitigated our risk by doing 1, 2, 3, 4, 5.
Mm. Eh,
Yeah.
that is another. It's a scary one there because I'm not sure that you can collect rent, but because there's other structures similar to what I'm thinking of doing there, I took a phone number of the letting agent there. I just
Yeah.
haven't been able to get hold of them because I wanted to inquire. So how much are these properties or the rentals going for,
Okay.
and just to assess, is it possible to go with that structure
Yeah.
or that strategy rather in that area. But there's a lot of flats that I saw there, and people are building lots of flats in that area.
Okay. Okay. If there's still development, then that's fine. That means that there's still demand in the area.
Mm,
Just make sure that, but you cover your risk. You make sure that you do your homework, find
mm,
out if there's a letting agent that is working in the area. Let
yeah,
them tell you about how their success rate in terms of
yeah.
collecting and chasing. What happens when people don't want to move? Are they good at that? And do they work with somebody to try and evict people and stuff like that? So do
Mm,
your homework and then invest.
mm,
Obviously, I'll look at the numbers, but in terms from the risk point of view, you gotta do that assessment yourself.
yeah, true.
Yeah.
All right, no
Okay.
problem. I saw you there on TV. I was watching it with my daughter, and
Yeah.
she's saying, I heard Doris say your name. I'm like, you lying. Hey, Wena. Hey. I'm like, you're such a liar.
Are you
But yeah, no,
serious?
yeah, she says, I heard her. She said your name. You know how kids, she's 9, so she's got a wild imagination. Yeah, but it was a nice show. I watched it.
No, no, no. I'm glad to hear that. Eh?
Yeah.
No, 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 I'm glad to hear that. I do have 2 more episodes to do. Um,
Okay.
yes, yeah. I think the next one is I've already done that recording is episode 2 because this one was episode 1 for the
1.
season.
Yeah.
I'm not on tomorrow, but I'm on next week, and then I'm also on for another episode. I think it's episode 9 that I'm going to shoot. Yeah,
Okay. When does
yeah.
it play? Is it once a week?
So the main show is at 8:30 on Wednesdays.
Yeah.
And then it repeats all the days except for Tuesdays.
Oh,
So
okay.
the repeats, unfortunately, is at different times, but it repeats every day. So from Wednesday, it'll repeat again on Thursday, Friday. You know how
Oh,
these channels are. They
this
like
channel,
to,
yeah.
and they like to
But
repeat
the
stuff.
main
But
show 8:30 on a Wednesday.
it's Wednesday, 8:30. So
Okay.
it actually shows for the first time on Monday at 4:30. And then, but the way they run is that the main show is because it's the prime time, it's the
Yeah.
8:30, and when the other ones are repeats, so it's during the day. So either morning, Sunday morning at 8 or 8:30, Saturday lunch around 1 or something like that. So the times varies, but they work. So the main times is the prime time, which is 8:30 on Wednesdays.
Okay.
Yeah.
All right.
Okay, Sis Mott, we'll definitely talk when you send me some numbers. Sis Messi.
Yes, Sis Doris.
Yes. Are you okay?
Hey, I'm fine. Yeah. I just hope there'll be a breakthrough very soon.
Yes. Please do when you find something, please don't hesitate to still send me to have a look at.
Okay.
Yeah. It's my job to make sure that I see you having a deal. So that's my job. So for me,
Yeah.
we just want to have these sessions, but you're welcome to send me emails. I really don't mind, guys. So if you've got a deal that you want me to have a look at, I honestly prefer to look at deals. It's much easier than to ask me general questions. So I can guide you through an actual transaction.
Okay. Thank you.
All right, guys. It's been
Thanks, ladies. Thank you,
Yeah.
Doris, for
a
everything.
pleasure. And we'll definitely see each other. Okay, if you've got your screens on, I'll definitely have mine on the Q&A sessions if need be. And yeah, we'll also answer in the background if people have got questions. Yeah.
Okay.
Okay.
Okay. Maud, bye.
Thank you. Bye. Bye, Messi. Bye, Aus Messi.
Okay.
Okay.